Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and Independent Advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. We also have Leith Van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com. Yes, hello and welcome to yet another instalment of Nucleus Insights. And today we're going to be looking at Australia's favourite boom, being, of course, Australian housing and Australian property. We've got a full house again today. We've got Leith, David and Damien on board. So hang on to your hats for a terrific series. It is quite chart heavy today. And so for those that are listening in on our new podcast channels, feel free to head over to the Nucleus Wealth website, which is www.nucleuswealth.com. Head over to the webinar links, and in the post that we put up that has the webinar in, it'll also have a slide pack in PDF form for you to download and check out. So on with the show, we've got for the agenda today, we're going to be looking at the Australian property market structure, so some historical graphs to sort of provide a little bit of perspective on our thoughts in the way that, or certainly the way historically the Australian property's gone. We're then going to look at where we're at in the current cycles, and also then roll into a little bit of I guess a borrow of thoughts from last week's presentation on the Aussie banks in what affects the what's come out to be some pretty poor lending standards will potentially have in regards to Australian property prices. We'll then look at what potentially can be done. So by way of policy responses and other factors that might help alleviate some of the issues that we see going forward. And as always, then parlay this into some investment implications in regards to how we run money at Nucleus Wealth every day. So on that note, we'll jump into it. And we'll start off with the Australian housing total housing stock. And welcome to you, Leith.
G'day, Tim. Hello, everybody. Yeah, look, we've just put together a whole bunch of charts here, basically to show where the Australian housing market in a historical context, just to sort of show where we've come from and where we currently are. And what we've got here is the first chart, which shows, it's basically a valuation chart, which tracks the Australian housing market all the way back to from the 1960s to now. And it shows that that the value of Australia's housing stocks increased from about 3 times incomes up until the late 1980s to nearly 8 times incomes currently. It also shows that that Australia's housing stock relative to the economy, that is relative to the value of GDP, has increased from less than 2 times GDP up until the mid 1990s to 3.6 times GDP currently. And most of this increase has actually occurred since the late 1990s, which, for those looking at the chart, can see that there's been a real ramp up in the value of Australia's housing stock over the past really 20 years.
Okay, fantastic. And then looking at, I guess, breaking down that national look into the various states.
Yeah, that's right. Now we've got a chart here, which is basically a snapshot chart. So it's not a time series. It's just how these markets sit currently. And as you'd expect, most of the overvaluation or the expensiveness of Australian housing gets back to the two major markets of Sydney and Melbourne. Sydney's housing market, its dwelling prices are priced at around 10 times household disposable income currently, whereas Melbourne's are priced at around 9 times household disposable income. And relative to rents, Sydney's housing market's at 31 times rents, so it's huge, and Melbourne's even more expensive at 33 times rents. And these compare to a national average of just under 8 times income and 29 times rents. So really the overvaluation is concentrated in Sydney and Melbourne. Now, all the major housing markets pretty much ramped up at the same time up until about 2010, but all markets bar Sydney have basically corrected against inflation since then, whereas Sydney's and Melbourne's has continued to skyrocket. And in fact, Sydney's house prices rose by about 2/3 from 2010 until late last year. They've since fallen a bit, whereas Melbourne's went up almost 50%. Whereas all the other major markets actually went backwards once you adjust for inflation. So, whereas Australia's housing values skyrocketed everywhere, they've kicked up particularly in the two major markets over the past, since the peak of the previous boom in 2010.
Okay, sure. So it really is a tale of two cities there. And then looking into housing stock versus the gross domestic product or GDP. And I guess we've got there a graph for those listening in of a reflection against Australia, United States, Canada, United Kingdom, New Zealand and Ireland. And certainly Australia and New Zealand are leading the pack.
Yeah, that's right. Look, so what this chart does is actually plots the historical changes in Australia's housing values compared to GDP against the other Anglosphere nations, so the other major English-speaking nations. And what it shows is that Australia's right at the top. We're actually slightly behind New Zealand. New Zealand's housing values at GDP were ranked at 3.8 times GDP, whereas Australia's at 3.6 times GDP. But we've kind of increased at a similar rate. We've got the same banks, similar policies, etc. A long way back, we've got Canada at 3.1 times GDP, UK at 3 times GDP, Ireland at 1.7 times GDP, and the US at 1.4 times GDP. So the US is actually less than half our valuation, and Ireland's almost half Australia's valuation, but Ireland obviously did bubble up in the mid-2000s and has corrected quite sharply. So again, we're right at the top of the pack there.
Certainly seems like an award you don't really want to have, particularly when you compare this against the debt there. So moving on to our next slide in a similar, or same countries obviously, but now looking at household debt to GDP.
Yeah, look, as most of us know, the fuel for housing prices is actually mortgage debt. Now, I can't get individual data for each of these countries on mortgage debt, but what the Bank for International Settlements does do, provides a quarterly stock take of household debt to GDP across pretty much all economies. And I've got a chart here, and it again compares household debt to GDP against the other major English-speaking nations. And what it actually shows is that Australia is way out in front. We've actually got the second highest household debt in the world behind Switzerland, and we're way out in front amongst the Anglosphere. Australia's debt to GDP is 121%. And way back in second place is Canada at 100%. So we're way ahead of the rest of the pack. And then we've got New Zealand at 92%, UK at 87%, US at 79%, and Ireland at 49%. And we'll also add that Australia's debt to GDP, which is 121% currently, is even higher than Ireland's was at the peak of its bubble. Ireland peaked at 117%, but has since fallen, significantly. It's actually more than halved. So it is a bit of an alarming picture.
Absolutely. Okay.
Yes, yeah. So we're talking about household debt to GDP, not mortgage debt to GDP, but obviously mortgage debt comprises the majority of household debt.
Okay, sure thing. And then I guess just a quick reflection here. We've got a graph up on young owners, or the home ownership of people aged 18 to 39. It's got the major cities there: Sydney, Melbourne, Brisbane, Perth, and Adelaide. But across the board, essentially over the last decade and a bit, we're looking at some pretty a fair old slowdown. I think you could probably evenly say.
Yeah, look, home ownership rates for those aged under 40, which is produced by the Household and Income Labour Dynamic Survey, has plummeted since 2002. And the data only goes from 2002 to 2014, but what it shows is that it's plummeted across all the major markets, but it's fallen particularly sharply, of course, in those most expensive markets of Sydney and Melbourne. So in 2002, 29% of people aged between 18 and 39, were homeowners, whereas in 2014 it had fallen all the way down to 20%. So from 29% to 20%. For Melbourne, the fall's even been more drastic, and home ownership rate for those aged under 40 has fallen from 35% down to 20%. So we're talking about huge changes here, whereby home ownership has collapsed, particularly in the most expensive major markets.
And it is, I think, it's an obvious reflection on the difficulty that young people are having today in getting into the market anyway. Would you agree?
Oh, absolutely.
Sure thing. Okay, so if you're not buying, you're obviously renting. And we've got an interesting one here on the graph on the annual rental growth by capital city. Some fairly dramatic moves from Perth and Darwin, but on the whole, it looks like there is a trend down.
Yeah, rental growth's actually fallen very sharply over the past sort of 5 years. And nationally, rental growth was only 0.8% in the year to March. And that's actually about half the rate of inflation. But there's massive variation between the cities. So the strongest rental growth's been in Sydney, which has had 2.4% the year to March. Melbourne 2.2%, Hobart 3.7%, and Canberra 2.6%. But we've had significant negative rent in Perth, which has fallen by 6.3% over the past year, and Darwin by about 6%. And Brisbane's also gone negative to the tune of 0.5%, whereas Adelaide's been broadly flat. So the rental market overall has been weakening, but again, there's this big variation, and Sydney and Melbourne's rents have actually, could continue to outpace inflation and as well as income growth, really.
And so, do you think this is, or what are the factors behind this? Could it be, obviously, lower wage growth potentially that's forcing people to forcing people to have less to absorb rental increases, and therefore that landlords have to respond by lowering, or is it raising in prices? Or
look, there's a few factors. One of them is obviously wages growth. I mean, the difference between rents and the broader, and obviously purchasing, is you can't leverage rents. So you can't borrow to pay for your rent, and you've got to pay for it with after-tax income. So as we know, wages growth's been incredibly slow across the entire economy, not just in a few markets, but pretty much everywhere. So that's obviously weighing down on rents, and also the supply situation also matters. There has been a pretty big increase in dwelling supply across the nation, and particularly relative to population growth in places like Perth and Brisbane, which has pushed down their rents into negative. And on top of that, you've obviously got economic conditions. So we've had a mining correction in Darwin and Perth, which has crashed the economy and has pushed down rents. But Sydney and Melbourne, we have had a big construction uplift, but construction has, but obviously population growth running very high in those two markets. So that's put a floor under rents.
Okay, yeah, Damien, something to add?
Yeah, I think it's probably a good time in terms of, based on that question, just to pop in something about some of the back of the envelope type figures on these, just to keep in mind that you only need small changes in people's behaviour to actually make big differences. So there's just back of the envelope numbers, we've got 25 odd million people in Australia, roughly 10 million houses, and so you're about 2.5 people per house.
Yeah, okay, sure.
Now, so if you change that from 2.5 to 2.6, so a few more kids stay at home with their parents, a few more people get an extra flatmate, that type of stuff. Your spare room gets rented out. The holiday house gets sold and somebody moves into it and things like that.
Sure.
That makes a difference of about 400,000 houses.
Yep.
So just a relatively small change, and that's probably over sort of 2 years demand.
Yep.
So for houses, so I guess where I'm leading to with that, and what that's sort of partly showing in some of those markets is that if you've got wage growth, then people can afford to move out and they can afford to have their own place and they can do things like that. And if you don't have the wage growth, then they tend to drift back into, more people in a share house, more people living at home with their parents and things like that. And so supply and demand are obviously very important, and the number of houses being built and all that type of stuff is very important. But in my mind, if we're talking about will 180,000 houses be built, or will it be 250 houses, or will it be 150, you're mucking around at the edges. The real assumption is, well, will it be 2.51 people per house? Will it be 2.47 people per house? That type of thing, which actually really drives the numbers, because we're looking at such a large base on such a small year-by-year change.
Okay, yeah, sure. All right, yeah, no, that's very apt. Okay, finishing up there with rental prices, and our historical view, we can now move into the next stage, being the current cycles that we're sitting in at the moment, and a little bit more look at the now, I guess. So obviously we've got a chart up now of the Australian finance commitments versus dwelling price growth. An interesting one, because it sort of shows over time, and I think we've got about 24 years worth of data there up in the chart, that they do appear to be in the past quite strongly correlated, Leith. However, that seems to be changing in the last few years.
Yeah. So what we've done here is we've plotted the total value of finance commitments, so excluding refinancings, versus dwelling price growth, and this data goes back to the early 90s. And what it shows is there's an incredibly strong correlation, as you'd expect, between the growth in finance commitments and house prices. So when the value of housing finance is rising, house prices are rising. When the growth in finance is falling, house prices are falling. And this has been a really strong relationship up until a couple of years ago, when the series did break apart a bit. And what actually happened was house prices were continue to rise when actually finance commitments were falling. And what I think was that might have been driving that was a large increase in overseas buyers.
Okay.
So, and a lot of overseas buyers pay cash, so they don't borrow through the mortgage market. So they can help increase demand and push up house prices without actually borrowing. So it's not reflected in finance commitments. But what we've seen over the past several months is that those two series have converged again, and we've got a situation whereby house prices are falling at the same time as housing finance is falling again. So I think this relationship over the long term obviously holds, but there was a bit of a break over the past couple of years, and currently house prices are falling and finance commitments are falling.
Okay, wonderful. And David's got something to add there?
Just to reinforce the point that foreign buyers, were probably responsible for that dislocation. The reconnecting of housing finance with prices transpired alongside China's closing of its capital account.
Okay.
And so, correlation isn't causation, but there was certainly a very obvious relationship between the money coming out of China drying up and the reconnection of Australian housing finance with prices.
Okay, yeah, sure. Fair enough. And while we're on the topic of prices, then we'll move over to our next graph, being capital city dwelling price growth. It certainly agrees with that previous chart in the sense that it's all on the way down, except for maybe Perth. But who knows what's happening in Perth? Not great things from the sound of things at the moment. Thoughts, Leith?
Yeah, so we've got a chart here which just shows the CoreLogic's dwelling price growth series, and what it shows is that dwelling price growth is falling across all major markets, except Perth, where it's actually pretty flat, but it's flat negative, so it's just continuing to fall, but at the same rate. And just to put some numbers to that, Sydney's dwelling prices are down about 4.5% over the past 7 months, whereas Melbourne's dwelling prices are down about 1% so far this year. And nationally, values have fallen by 0.8% over the past quarter and are down about 0.5% year on year. So after an epic boom pretty much since 2010, dwelling prices nationally are now falling on year terms, and they're and this has been driven mostly by Sydney, although all markets are slowing.
Okay, sure thing. Sorry, moving on to the next one there. So we will zoom into the clearance rates. Now, sometimes I suspect the clearance rates that are published have a little bit of number wang in them, but I guess you can take them on thematic grounds, can you?
Yeah, look, CoreLogic's auction clearance rate series is actually pretty good.
Okay.
They do revise them once they get all the data through and etc. But it's certainly not perfect because only a fairly small minority of homes are actually transacted through the mortgage market, even in places like Sydney and Melbourne. But they still do provide a decent correlation with prices. And what we're seeing is that the national auction clearance rate's fallen to around 60% currently, and this is it's fallen fairly sharply. It was at the same time last year, it was running at nearly 75%. So it's slowed quite considerably. And again, this has been driven by Sydney's auction clearance rate, which has actually fallen below 60%. Versus about 74% last year. So, and Melbourne's is also down fairly heavily from 78% last year to 65% currently. So it's just another one of these indicators that suggests that the housing market is weakening. So we've got finance obviously falling and also auction clearance rates falling. So they're pretty good snapshots. If I was to rely on one indicator over pretty much any other, if you want to gauge the housing cycle though, I'd look at housing finance because just because of the really strong correlations, and it really is the fuel that drives the housing market.
Okay, sure thing. And certainly a 20% fall year on year in any indicator is always cause for concern, I'm sure.
Yeah, that's right. Look, there's no doubt about it. The market's slowing. Nationally, prices are falling, and it's been driven by Sydney, but Melbourne's also following suit.
Yep, sure thing. Okay, thanks, Leith. We'll jump across now to lending standards. So for those that want a little bit more of a deep dive into the banking and the Banking Royal Commission, I strongly suggest checking out last week's podcast and webinar. But we'll just have a quick reheat of it today, just of course because of its absolute relevance in what's happening in future property prices. So David, welcome.
Yeah, thanks, Tim. So Leith, looked at the structure of the market and where the cycle is today, and I thought we'd look at some lending standards material to give us a hint on where mortgage finance is next headed.
Okay.
As he said, that's the sort of key indicator in terms of future prices. And so we've got a couple of charts here from UBS, which are derived from some of the material that's come out of the Royal Commission looking at Westpac's loan book. And without being too specific, there are some extraordinary assumptions made in the Westpac loan book that make it look, make the metrics on many of its mortgages look very stretched.
Okay.
Expenses, 90% of expenses have been benchmarked to the household expenditure survey instead of the specifics of the individual client. And so that's been the minimum standard that's been used for expenses. And some of the other banks, for instance, BOQ, has watched this from the sidelines and actually said yesterday or the day before that it knew it was happening, and at the same time it's been doing individual expenses, and its estimate for the impact of having to use actual expenses over the benchmark is that mortgage growth would be half what it is. So that would take it, from today's kind of 6% down to 3%. And that's roughly, getting pretty close to the lowest levels of mortgage growth that we've seen for 50 years. We've got sort of down that low briefly during the rate hikes of the mining boom in 2010, and house prices then were falling at between 5 and 10% across the country.
Yeah, okay.
It's
Damien?
worth noting though as well that in the long term, it's hard to expect that mortgage growth can be significantly above income growth. So there's a little bit of saying, well, things get a bit cheaper as time goes on, and so you've got more money you can allocate to your house if you wanted to as an expense. But long term, there's obviously a cap to how much you can actually have as a mortgage, and so once you're close to that cap, then you're basically growing at your wage growth rate after that.
Yep, fair point.
Yeah, and as we know, wages are not growing very fast. So, I mean, the upshot of these UBS charts is that some of the banks, in particular Westpac at this point, but probably some of the other majors as well, are going to be forced to slow their lending coming out of the Royal Commission as their standards rise on various measures, income assessments and expenses, etc.
Okay.
So you want to just shift those,
Yeah, we'll
those
jump in.
charts. Keep going. And that is coming on top of what we already had. We had that was causing prices to decline before the Royal Commission, which was macro-prudential.
Sure. Yep.
That APRA had put into the market because the Council of Financial Regulators had become quite concerned about the
Growth.
accumulating leverage
Yep. Sure.
in households. And that macro-prudential, there were two rounds, as we know. The first one was to cap investor lending, and that worked for a while, but then they cut rates and it took off again. Round two was to cap interest-only loans
Yep.
at 30% of total lending, and that caused the handbrake to really be pulled on the price boom that we were seeing post 2010, because a lot of that, a huge component of that, at times 40 and 50, even 50% of lending was interest-only, which is really Ponzi lending, the kind of stuff that we saw that underpinned the US housing boom. It's not, sustainable mortgage lending at all. It's really just a punt on capital gains.
Yep. Okay. So I'll step back just as a definition of a Ponzi lend.
The strict definition from Minsky, I think, was simply someone who can't really either pay back principal or interest. They rely almost entirely on capital gains.
Yep. Okay.
To fund the investment, or the speculation. So it's just a straight up punt.
Yep.
On prices going up.
Sure.
He had two other definitions. I think hedge borrowers was one, which is just your standard you and I who can pay principal and interest. There was a second, I can't remember what he called it actually, but that was someone who's able to pay interest but not principal.
Sure.
And then there's your outright Ponzi borrower. And so Australia's got more than its fair share of the latter two. And the question now is with the macro-prudential coming in quite late in that boom, and what it did, because it ran for sort of 4 or 5 years, it's created a cliff where, it began in 2013, and then most of these loans have a 5-year interest-free period, and then they reset. And so this year they've started to reset upwards, just when APRA has capped the number that can be sort of redeployed. So there are open questions about how much capacity the banks have in their front book and back book, that is lending flow and stock, of how much of this stuff they can refinance. Now that chart there is my guesstimate of what is a sort of abnormal reset.
Okay.
Beyond, what they're used to absorbing as refinancing for their Ponzi borrowers. It's my best guess of what will be under some form of stress, unable to refinance or having to refinance to principal and interest.
And we can see there in 2020 it sort of peaks out at a touch over 3.5%, which, whilst it doesn't seem like a lot historically, is amazingly high.
It's very big, yes. You have to realise that any of these busts or price changes transpire at the margin. Like the marginal price setter is what shifts the price up or down.
That's the market, isn't it?
It is. And so if you have 3% of the market suddenly unable to refinance and forced to sell, then that actually creates price pressure across the entire market. And that's where you get contagion into broader conditions, is because prices start to fall more generally.
And the confidence
You wanted
falls.
to say something?
Yeah, and
Damien?
it's worth noting as well. As Dave said, it's at the margin, but at the margin for somebody who's got $300,000 or $400,000 worth of debt, you're talking $5,000 to $10,000 extra they need to come up with. That if they were sort of pushing things to the limit to take out an interest-only loan and either barely paying for the loan with the interest or having to chip extra money in, and now you turn around to them and say, well, yeah, here's another $7,000 we'd like you to pay
In
in
principle.
principle as well over
Yep.
the next year, is, they just don't have the capacity for it. And at a certain stage, they just have to go, well, it might be able to draw down for a little bit, but then you start hitting limits, and then at that stage, you just have to give up
Liquidate.
at some point.
Yep. Okay. Fair point. Very good. Anything else on interest rate?
Especially, of course, if prices are falling.
Well, yeah.
And you're running a negative carry into a capital loss. It's a pretty bad position to be in.
Not exactly investing 101.
No, it's not. So that's pretty tough. But so there's one more dimension to add to lending standards as they are, and that is that global funding costs have been rising quite sharply, and some of that's just the Fed and it's tightening.
Okay.
But it's also it's resulted in short-term funding costs rising here very quickly. Estimates of the blow to bank profits is already in the vicinity of 3 to 4%.
No, I don't think we've got that chart. Sorry.
I didn't bring that chart. I'm sorry. And so there's the prospect of the banks having to raise rates to protect their net interest margins, as well as raising lending standards out of owing to macroprudential and the fallout from the Royal Commission. So you have a number of material negatives converging on the availability of credit, possibly the price of it as well. And so, at this point, we're shooting in the breeze, but it's a fair bet that this adds up to sort of prices continuing to fall at 5 to 10%. Probably for the major markets,
Sure.
Sydney and Melbourne.
Well, that's actually, it parlays quite nicely into a question that we've had pop up from one of our viewers live. That there's a couple here, actually. So one is, do you see a slow deflation of the market, or is the market being primed for a pop? And I'll give you the other one as well. You might be able to answer them both the same line. Given the banks are borrowing from overseas, as you mentioned before, how many basis points do you think the Royal Commission will add to the borrowing cost? It's a fairly broad...
Well, it's impossible to know how much funding costs will go up, but so far it's all been at the short end for funding costs. It's been short-term borrowing that spiked. Long-term borrowing remains relatively cheap.
Oh, that's just the question. That's okay.
Sorry. But it started to rise as well. The long-term funding costs is where the government guarantee comes in as well. So it starts to get quite complex because you've also then got to look at where the global economy is, as well as the budget. I think you can say the base case is that we continue to go slow melt.
Okay.
However, the risk case is, let's put three cases. The base case is prices keep falling in the slow melt. That's probably the best case.
Okay.
Right. The base case is that it gets a little bit worse. I think because largely because the convergence of the things that we've already discussed, but also because the global economy itself is pretty clearly headed into an aging business cycle. And so at some point in the next year or two, as we slowly deflate, you're going to get another external shock. We can already see China slowing. That's not, I don't think, likely to cause a renewed global shock. I think they'll keep things sustained. But we're going to get our next hit to the economy is going to be another income shock coming out of China through the second half of this year, which will slow us down again and make things still more difficult. But then you've got the US raising rates and the Trump boom going with its late cycle fiscal stimulus. And at some point, US inflation's rising, the Fed is going to come together with that. At some point, we're going to have a stock market shakeout, emerging market rout, and another round of global recession. I'm not talking about a new GFC, but just your classic end of cycle accident that we get every 8 to 10, 12 years max. We're already at the second longest business cycle in known history. So we know it's coming.
All good things have got to end at some point.
That's right. And so what always transpires when you get one of these accidents is that global funding costs rise. And if Australia is going through this slow melt with so many of these negatives, keeping house prices, pushed down at 5 to 10% per annum in the major markets, then it's hit by the global shock with more rising funding costs. We find ourselves in a position where the RBA has perhaps 2 rate cuts left in the bag.
Sure.
It doesn't want to go to 0.
No way.
Because it's afraid the dollar will collapse. It maybe has 3 rate cuts to 75 basis points, maybe. But it'll leave some of those forever. Like our zero interest rate policy will very likely be 75 basis or 100 basis points.
Okay.
So you will have very little mortgage relief. In fact, because of all the funding costs rising, the banks may pass on, in fact, almost certainly will pass on bugger all of those cuts. So the cut a long story short, mortgage rates are at the bottom now, even if we get a shock. And so there'll be, during the GFC, for instance, there was something like 425 basis points of easing by the RBA. Roughly 3% of that got passed on to mortgages. I mean, the income relief for households was enormous. This time you'll get a shock with no relief. Then you look across at fiscal policy, and there's more in the tank there. Our public debt is still low. However, it's more constrained than it appears because the public balance sheet guarantees the banks, and so that private debt is a contingent liability that the ratings agencies demand that the public purse remains very clean. So it's more constrained than it looks, so you won't see another fiscal stimulus like you did in the GFC. You'll see something substantial, but not like that huge push that we had that saved the economy. And so you get this convergence of the supports that have held this bubble in place running out of ammunition, just as all of these negatives also converge on the market. The other negative is China and its closed capital account. That doesn't look likely to open at all in the near future, so looking for a save from foreign investors is unlikely, which really leaves us with our last chart.
Okay, sure.
And if you want to move that over, and that is the last kind of lever that the government can pull to try and save the market here, other than bits and pieces, where it's first owned buyer grants and other things, which we'll most certainly use.
And we'll jump onto those in a minute in the policy responses.
But its other big lever is population policy, and can it keep population growth going at its current rate? And, as we see on the blog day by day, it's done this now. It's run high population growth ever since the mining boom went bust in 2011, which was very ill-advised. Instead of allowing an adjustment to take place that made us more competitive, it tried to backfill everything and support it with just masses of millions of more people.
Just turn up the demand flame.
Yes, that's right. And so we now have a situation where all the major cities are close to revolt on population because they're crush loaded, living standards are falling, wages can't rise, infrastructure is straining, and so there's a lot of anger about population growth in the polity, and so it raises a question about whether it can be used cyclically now as a bailout for houses when structurally it's looking very, very politically troubled. I can't say one way or another, and that attitude may change if things get rough and people just say, okay, we've just got to grin and bear it because this will keep us going. Hard to know.
Yep.
But population growth is a bit of an unknown, and to my mind looks at risk. So that means 2 of your 3 major supports are not what they once were. One of them is pretty poor, and the other 2 are troubled. So it just means your big saves are much more difficult from a policy perspective.
Okay, sure. Thank you. Thanks for that very long and detailed and quite cheerful answer to our viewer's question. Allowed us to get through one more slide. Just while we are, finally, we are going to talk about policy in a moment, but whilst we're on population, obviously a very key theme to the Macro Business blog and a lot of what Leith does every day. So we'll give Leith an opportunity to discuss this one.
Yeah, look, actually, I want to just refer back to the other question about the impact on whether or not the Australian housing market's going to have a deeper correction or not. I agree with everything Dave said, but I personally think the Royal Commission's a massive smoky here. As we showed earlier, mortgage credit basically drives house prices. So we know basically the Royal Commission's come along and it could end up being a huge pro-cyclical shock that's going to hit Australia right at the peak of the market at exactly the wrong time. From the Royal Commission, we're likely to see bank boards become more risk averse. We're going to see banks likely to tighten lending standards, which is obviously going to restrict credit, leading to obviously falling house prices if you've got falling mortgage growth, increased bad debts, and potentially lower profitability for the banks. As we said in last week's podcast, this whole veil that Australia's got safe and secure banks and prudent lending standards have been blown apart. So foreign lenders to the banks, like the banks have borrowed about $850 billion offshore, which a lot of it's gone into funding mortgages. They're likely to become more risk averse, so they'll demand higher interest rates from the banks, which of course will raise funding costs and flow into mortgages. Obviously, Dave's mentioned the flood of interest-only mortgages that are going to hit the market, so that's another headwind. And of course, Labor has promised if they win the next election that they're going to introduce negative gearing and capital gains tax reforms. So assuming they win at the end of this year or the early next year, it'll probably come into effect mid next year. They've committed, they've thrown the kitchen sink at this, so I can't see them unwinding it and backing down. And if that comes in mid next year, or even late next year, that's obviously going to further crimp investor demand, and that's going to have a huge impact, particularly on Sydney, which is whereby 60% of its new mortgages are from investors, and Melbourne nearly 50%. So it's just another headwind that comes on top of all the other headwinds. As Dave said, the best case scenario is that we get this slow melt, but really the bets are off if we get some bad responses from the Banking Royal Commission, add in a global shock. Obviously, Labor's negative gearing policies baked in should they win. There's a whole bunch of factors here which could turn the correction nasty.
Okay, thank you. Cheers, Leith. I think it was probably the best answered question we've had on the on the webinar so far. So I hope you're happy with that one, Sooty. We'll jump across now into policy responses. So obviously, there's a number of issues at front here, and at the end of the day, we can choose to sit on our hands, or the governments of the day can choose to do something about it. We've chucked up a couple of things here. Do you want to get the party started, David?
Sure. Well, I've kind of run through some of this already in my answer, but monetary policy, chamber's nearly empty. The next step for the RBA, if it's forced to do it, is quantitative easing. There's still a huge question about whether that's possible.
Okay.
Like some small open markets have done it, but only in Europe, and they're running current account surpluses, places like Sweden, Denmark.
Mm-hmm.
And their proximity to the EU, I think, is important too in providing forex stability.
Yep.
So could Australia do quantitative easing? I really don't know, but a few people are talking about it as a possibility. I think the key consideration on that front is that they're not going to do it without a crisis.
Sure.
So
need a catalyst.
Yeah. So the catalyst is obviously falling house prices to begin with. So it's something that will mitigate a bust, a quite nasty bust, not prevent it.
Yep.
Macroprudential, as Leith said, the Royal Commission is going to play a role here. I think we already have, the two rounds. The first round that capped investor lending at 10% growth has been removed because the market is only growing at like 1.7.
Okay.
And when it was removed, APRA also declared what was effectively a macroprudential 3,
Right.
third round, when it said it's no longer acceptable for banks to use benchmarks on things like expenses.
Okay.
That's straight out of the Royal Commission. That's the HEM I was talking about earlier.
Yep.
And that's why Westpac has already deployed an entirely new regime for assessing client expenses. And as we've already discussed, that could halve mortgage growth all by itself.
Sure.
The other thing I think that's of interest here is, as we were talking about with the interest-only reset, if that does become really difficult for the market, it will become... I think the Royal Commission has made it much harder for APRA to remove that, because in effect it would be declaring interest-only back on.
Yep.
And after the Royal Commission, that's going to be a very poor look.
Mm.
You're effectively saying, go the Ponzi again. And it's already in such hot water and on the run to some extent, with backfilling its policy tightening, that looks quite difficult for it. So macroprudential looks tight and unlikely to be eased. Fiscal, we talked about. There's some first home buyer grants. Put your house on that, if you'll pardon the pun. But as we've seen, there's a first home buyer grant right now in Sydney and Melbourne.
Yep.
And prices are falling.
Mm.
The investor has been the marginal buyer.
Yep.
In those markets, and then it's the investor that's really in the gun for all of these tightenings. So unless you can get the investors back in there, it's probably not going to make a great deal of difference. I think to some extent the first home buyers are actually just priced out.
Yeah, sure. Yep.
Just a moment.
And obviously, with 50%, around that of investor lending, or current purchases as well, it's it's a pretty big part of the market.
Yeah, look, certainly the first home buyer stamp duty concessions have stemmed the declines a little bit. CoreLogic's data breaks down the price falls by segment. It shows that most affordable segments of the market have actually held up pretty well.
Okay.
It's been the middle and more expensive end of the market that's been falling the heaviest. So what that tells you is that Sydney's fallen about 4.5% in 7 months. If they hadn't done the first home buyer boost, which has increased first home buyer commitments by about 80%.
Wow.
Compared to the previous year in Melbourne, it's about 50%. The chances are prices would be falling a lot more. But as you said, Tim, 60% of Sydney's new mortgages are actually investors, and about half in Melbourne, or just under half. So, so the investors really are the price setters in those two markets, and all the first home buyer bribes has done is just stem the decline a little bit.
And that obviously brings us to our fourth point there in tax policy, and obviously a main one there being one of the key drivers for investors in negative gearing. And it seems like we've got split. It is a divisive issue in sense of the major political parties and a platform for election.
Yeah, well, I mean, this is really a fascinating question now, because if we're right, it looks like we're right, then house prices continue to fall. You've got two potential scenarios with an election probably in May next year, if not earlier, if the polls swing to the government, where, if you have the coalition re-elected, well, I guess my point is this: if house prices continue to fall into the election, does Labor's negative gearing reform policy, which has been a huge benefit to it to date, driving a lot of popularity for it, will it become a liability? Because if you have the Royal Commission triggering stronger lending standards and faster falls in prices, and say we get to the election and the national, or at least Sydney and Melbourne markets are down 10% plus, then we will most definitely be seeing serious impacts in consumption, growth slowing, bad loans rising. Things will look quite tough. And it will be very easy for the government to run a scare campaign on negative gearing reform in that environment. So, that could go either way. It could actually become a real problem for Labor. If it does get over the line and then takes it away, obviously house prices will be more troubled again. And you've got to ask yourself how it will respond to that. I mean, the obvious lever to pull is more people. Try and ramp up population growth even further, but as we've discussed, that'll be very difficult for it to do. I mean, the big cities really are genuinely in revolt, we think, over this. All the polls are swinging wildly against mass immigration, not multiculturalism at all. It's not at all an ethnicity or
That's a volume
race
thing.
issue. It's simply a volume issue and a standards of living issue.
Yep.
You know, the Libs have just pushed this way too hard. And they haven't handled it well. It's overly concentrated in Sydney and Melbourne. There's no viable policy to change any of that. And so Labor will face this terrible conundrum where it would have to ramp up population growth and kill wages.
Yep.
To try and save the housing market negative gearing reform is making worse. So, it's just interesting times.
Stuck between a rock and a hard place.
Yeah.
Very good. Okay. Now we've covered off on population, so we can zoom through this slide. But we will just finish up, as always, on some investment impacts. So where we look, given obviously the thoughts and themes that we've discussed in today's podcast, and then how that relates to what we do every day at Nucleus Wealth with client portfolios. And I'll invite to the stage Damien for your piece and thoughts.
Thanks, Tim. Yeah, so from an investment perspective, one of the key things I want to highlight is that we're talking about a fragility of the system. So I think with all of this, as David said, the base case is sort of a drift downward and back towards more normal regime. But we need to recognise that the risks are more to the downside than the upside.
Sure.
And that we can't see a lot that would actually sort of give us another leg of this. So if the risks are all to the downside, from an investment perspective, we need to be looking and saying, well, even if the most probable outcome is X, well, if Y happens, we might lose 20, 30%. And if there's not a lot of upside, well, let's be a little bit more conservative than you'd otherwise be.
Sure.
The biggest problem, and we spoke about this a lot last week, but the biggest problem obviously comes back to the banks, where you can get a fully franked yield of close to 7%, and so if you gross that up for the franking credits, it sort of puts it on a pre-tax return of 10%, which we spoke about. If you saw the bank shares and you thought they were going to fall by 10% over the next 5 years, that's a pretty good return. Bank shares fall by 10%, you're getting a 10% pre-tax return, 8% after tax in a low tax return environment.
Makes sense.
Yeah, that's a good return. The issue is in the downside case, then you're starting to look at some of the bigger negative returns, and certainly within the banks, we look and say, well, the upside from here is probably relatively limited for the next 9 months.
Okay.
In terms of it being, we think there's going to be a bit of there'll be lots more to go on the Royal Commission.
Absolutely.
We've also got there'll be a bit of a bidding war we're coming into an election next year. There'll be a bidding war between who can punish the banks the most. The coalition, who would traditionally not bank bash as much, they sort of painted themselves into a bit of a corner of trying to avoid the Royal Commission, and now they need to at least make some things to make it look like they're going to be tough on the banks, which is probably going to have to actually mean they are actually tough on the banks. So I guess what I'm saying is, look, from an investment perspective, if you're confident that we're going to sail through this and the property will be a deflate and all that type of stuff, the banks are a buy, and they're cheap.
Yep.
We're a bit more concerned, and so we've been underweight for a while now, which has been since the inception of the portfolio for sort of 9 months ago, and so that's been good to date.
Okay.
Where there is stronger arguments now as you jump back in and you ride this up. We're happy to wait and see for the next 9 months, because we don't think there's going to be a lot of upside in them while the whole Royal Commission and election is going on.
Rolls on. Yep.
And let's make a decision later on and sort of leave that, because we don't think you're going to lose much.
Okay.
And there's potential that it could be there could be some downside.
Sure. So property developers.
Look, these are two-edged swords in terms of property developers. I mean, they usually have huge land banks, and so there is one element of their business where you're saying they're going to lose money on that part, and they don't have as many. It's not as much of a free kick. If you takes you 5 years to develop something, you buy the property. In the meantime, the property is increasing at 5 to 10% per annum. By the time you sell it, it doesn't really matter whether you did a good job or a bad job on your financials or the development. You've made it just from your land.
Sure.
That's not going to be the case anymore. Yep. So I think you certainly need to factor that in. The flip side is if we a lot of what we spoke about was, well, do we just see an increased population push, and so maybe the development side still needs to keep ticking along. So there's sort of it's a little bit two-edged, and I guess I don't want too much exposure to property developers, but I can see an argument for volume side ticking along, and so as long as you're getting them very cheap, which most of them are pretty cheap, then there's an argument for having some exposure. Retailers, they're having it tough already. There's other issues, but I guess it's what we wanted to highlight is certainly the elements like the Harvey Normans who are selling furniture, and people like Bunnings and things like that are very leveraged to the property cycle. Yep. And that when property markets go up, people spend a lot on their houses, and they spend a lot on the furniture that goes into new houses or new renovations.
Yep.
I've just spent $100,000 renovating a couple of rooms. Well, what's another $5,000 to give them some new couches and furniture and stuff like that? Sure. So, when it goes into reverse, they suffer on the same. So that sort of leads us back to these internationally exposed industrials, which is where we've thrown most of our money. It's been great, but they're very expensive, and so the net effect for the Aussie market is, look, we're not buying much in Australia. We're actually pretty underweight Australia, and overweight international, which has again been the right call to date. We still think there's more in that trade.
Okay. And sorry, so just stepping back there. So just for a definition for those that aren't fully across what an internationally exposed industrial is, or how that mechanically works.
Yeah, sure. So these are the stocks which are which have business operations overseas. Okay. And so the benefit of these is that if you're earning money, say let's say you're a CSL or a Cochlear or somebody like that who's got most of their revenues offshore, is that when you earn $1 in the US and the Australian dollar falls from 80 cents back to 75 cents, your dollar in the US is now actually worth more. Okay. So that's now risen, and you're getting the profits from that are higher, and so that goes back to increasing your earnings, even if your earnings don't go anywhere, just the currency translation.
Okay, sure, no worries. Thanks for that, Damien. And certainly, it looks like there's limited exposure or limited opportunity in Australia, but certainly plenty overseas.
Absolutely.
Cool. Okay, so if you'd like to know more about what we do every day at Nucleus Wealth, stay tuned.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay, and so coming up next week, same bat time, same bat channel, we've got Nucleus Insights, and we're looking at the Aussie dollar. We've called it as the Aussie dollar doomed. if you're interested in that, we're going to be obviously running through some of the somewhat precipitous fall in the last sort of fortnight of the Australian dollar, some thoughts behind that, and of course how that reflects back into our portfolios. If you like the sound of that one, head over to proton.nucleuswealth.com to register your interest so that we can send you any updates on the webinar itself and information, and of course book you in. Also, as I mentioned at the start there, Nucleus Wealth is now available on iTunes, and your favourite Android podcast program, Podcast Addict, has come up as quite a popular one. So if you'd like to listen to us as opposed to watch us, you can head over to those either to bit.ly Nucleus Insights or your favourite podcast player to load us up and listen to us then. And if you'd like to, as I said at the start, check out the charts that we do use, and quite often we are quite chart heavy, head over to www.nucleuswealth.com, the webinar section, and there is a link there for each, or a post rather, for each one of our webinars. And in that post, there is a PDF with the slide pack as well. So, as always, just as we're finishing up, please, for those that have signed up, please take a moment to fill out our survey that Maddie will be sending around. Gives you a chance rather to give us a little bit of feedback on how we've gone today, and also feel free to drop in any topics you'd like us to have a bit of a look into and present down the track. So on that note, thanks very much for your time. I've got a lot out of it, and I hope you did too, and we'll catch you at the next one. Cheers.